No surprise today as the Bank of Canada held interest rates steady at what is their second to last rate meeting of the year. And I think a sigh of relief being breathed by most of us, because even though the universal expectation was for a hold, there is still that element of fear of, hey, they've surprised us before. What's to stop them from doing it again? And I think a big piece of what gets lost in the economic analysis and projections and so on is the very real human impact this is having. This is people with strained budgets and higher mortgage payments and rising debt loads and job security threats and so on. So to hit that pause button at this one, I think is good for the Canadian psyche. What's interesting about this meeting is that it's accompanied by a monetary policy report. It's something we get every quarter that gives us a little bit more insight into what the Bank of Canada is thinking. It revises their projections for certain elements of the economy, and revise they did, in particular with the GDP numbers, which came down pretty significantly, as well as Canadian output. And there's also mention of entering a period of excess supply, and a component, probably a significant component, of the inflation we've seen has been excess demand, right? We've heard that term. Population growth has been pretty dramatic. Coming out of the pandemic, there was a lot of savings. Excess demand has been a massive contributor to inflation. So if we now flip that and enter a period of excess supply coupled with lower growth, lower consumption, all of these things should be inherently deflationary, which is what the Bank of Canada wants, or any central banker for that matter. So it's interesting then that they revised their projections for inflation upwards. Given all of this, how do you possibly revise your projections for inflation upwards? And I think there's probably two reasons for that. One, it's a little bit of covering their bases. The last 18 months has brought no end of surprise economically and internationally. And so for them to kind of cover their bases and say, okay, listen, we're going to plan for this. And if inflation comes down quicker, well, they've got the policy tools to deal with that. So it's a little bit of base covering. But the second is it's probably a little bit intentional and purposeful, because the market has been very reactive and responsive to what the Bank of Canada says and thinks. And so by keeping those inflation expectations or projections higher for longer, it creates the narrative or sustains the narrative of rates will stay higher for longer, which push up bond yields and push up fixed interest rates. And all of these things will serve to help spending lower and bring inflation down into target range. So I think there's a little bit of purpose there. But what's more likely is that we are done with rate hikes at this point. The way the economy is trending, the way the data has come in, it's likely that we only accelerate to the downside, whether it's GDP growth or consumption or the labor market. All of that stuff likely trends in the direction the Bank of Canada wants, so we're probably done with rate hikes. And what's more is we're probably underpricing how close we are to rate cuts. I think those are closer than what's being priced in. As of right now, there are 0 rate cuts priced into 2024, and I think it's likely we see probably some decent sized rate cuts going forward. So interesting to note. If you have questions, if you're out there and you're wondering how does this impact you, please reach out. Be happy to help and answer any questions, or if anyone you know, we're here to help. Take care.